Good afternoon, everyone. It's Ted Bader, President of SIA Wealth, and thank you all for joining our webinar today. We're going to be talking about a 2019 review and 2020 outlook. So I'm going to keep this moving very quickly. We have Jeremy is going to talk a bit about the outlook, and I know that's what most people listened in for. But before we do that, Paul Vendrinsky, our portfolio manager, is going to be discussing some of our funds and how they did in 2019, specifically our bond fund and our asset allocation fund, both of which are five-star funds over the last 3 years. And we had a very strong launch to our Focus Canadian fund. So Paul will take it over from here and just do a bit of an introduction. If you have any questions, please type it out in the question tab for the GoToMeeting, and we'll try to get to all the questions at the end. But in the meantime, I'll hand it over to Paul. Thanks.
Yeah, thanks a lot, Ted, and thanks everybody for joining us here today. Before we get to Jeremy to highlight some of the charts and stuff we're looking at, as Ted mentioned, I just want to kind of go over some of the stuff we're managing over at BMO here. We have our 5 funds. I'll start with the 2 flagship funds, the BMO Tactical Global Equity and then the Bond Fund. Those have been around since early 2015, and then off to the next will be the Asset Allocation Fund, and then our 2 newer ones that just crossed the 1-year mark. Essentially, we'll talk about the quarter end and the year end and since inception. Basically, for the quarter, at least, just as a summary, as most of you probably know, it got a little volatile and it was interesting. The U.S. completed the USMCA trade deal with Canada and Mexico, and then the phase 1 deal with trade deal with China really started to smooth things out from some of the volatility, and that coupled with some of the positive earnings we saw in the season helped really boost confidence and sparked a real risk-on trade and shifted us from a defensive stance to more aggressive, as we'll see over the quarter. So first of all, looking at the BMO Tactical Global Equity ETF Fund, this is our the way this is comprised right now is that we own 5 broad-based ETFs, 5 sector-based ETFs, and 5 individual stocks. Though it says the word equity in the title, this is a product that has the ability to move all the way from 100% equity to 100% short-term bonds, depending on our macroeconomic risk indicators. And we did see some swings in that this year, moving into the yellow equity action call. Jeremy will talk about that a little bit more, how that looked this year. But because of that, this shifted around a bit. So even though it has the word equity in it, it almost plays like a fully tactical, balanced mandate, or even like a market neutral. So for the year end, we ended off 100% invested in the equities markets on those 3 different areas I mentioned, predominantly U.S. equity, for the exception of a single Canadian ETF that we're holding. But again, it goes on our ranking, and we ended the year positive over 14%. Not bad for what this mandate was built to do and the way it's going forward. The next one I wanted to showcase here was our BMO Tactical Global Bond ETF Fund. Ted mentioned this is now sitting with a 5-star ranking through Morningstar over the last 3 years. It had a stellar 2019. It was our strongest performing year since the inception back in April 2015. What happened this year with the bond markets as a whole was a lot different than what people were suspecting about a year and a half earlier. In the later part of 2018, the consensus with the Fed was going to keep increasing rates throughout the rest of that year and then throughout 2019. Similar speculation with the Bank of Canada, when in turn both sides of the border did a 180, and bonds across both sides benefited largely. And this fund did so well, capping up above that 9% for the year because of the specific bonds it did own. The relative strength showed us to focus on the corporate bond market in that mid-duration 7-8 year mark, and it paid off in a big way. Both sides of the border, the corporate bonds outperformed everything else, and obviously we benefited from that. Since inception, we're annualizing just under 3.7% annualized, so it's been a really good performer for anybody's diversified bond portfolio. This one at the end of the year was overweight U.S. bonds, so it was suitable, or for people looking for yield diversification outside of Canada, it was a great fit. This year, however, recently we actually shifted to an overweight Canadian bonds, so we were overweight on the Canadian side, still looking at the corporate holdings as they remain up top on the rankings. Less U.S. exposure, but still some diversification outside of the Canadian yield, looking at currency yield. And on top of all of that, only investment grade. So this has been a good fit for a portfolio that has exposure to riskier bond assets or riskier bond ETFs. Moving forward, the BMO Tactical Global Asset Allocation ETF. This is our balanced fund. This is comprised of both equities and fixed income. And this, also similar to the bond fund, gained a 5-star ratings through Morningstar over the past 3 years. The way this sits right now is it holds the same holdings as the equity fund, with a 60% weighting on that side and a 40% weighting as a minimum on the same components within our bond fund. But what this allows us to do is shift depending on our overall risk macro weighting. So if you can see on the bottom right-hand corner, this shows how the allocations shifted. So we did see a shift with the equity action call into that neutral zone at the start of 2019. Actually started in 2018, but continued into early 2019. And then again in the fall of this year from early October to mid-November. What this did, it was automatically allowed us to shift on a defensive stance to a higher weighting of fixed income. In those periods, we moved to a 60% fixed income, 40% equity, which obviously with the performance last year with the bond fund helped us a fair bit with some of those roller coasters and the volatility. And at the end of the year, gained just under 9%, and looking since inception, April 2016, 7.66%. So again, this is a balanced approach that fits well in any balanced portfolio, giving you exposure on an international level through ETFs and fixed income. Jumping forward here to a couple of our newer names. These, we have 2 funds here, the BMO SIA Focus North American Equity Fund, also in ETF form under the ZFN. This just crossed the 1-year mark after coming out December 7th, 2018. This is a concentrated portfolio looking at the 15 strongest stocks in Canada and the US, but still follows our risk management parameters with the ability to move to a more defensive stance. And that's exactly what happened over this quarter. In October, when the equity action call went to the yellow zone, that our neutral zone, that's where we started to accumulate a bit of cash while individual positions were triggered for the sale. So what happened was about 30% or a third of the portfolio during that month, there were, or depending on how pieces were sold off during that month, accumulated cash held in short-term bonds, which eventually moved us back into being fully invested in mid-November after we moved into that green equity action call. At the end of the year, the portfolio was up 10%. Was an underperformance on the benchmark due really to that defensive stance, but that was a conscious decision made following our rules. We've seen this happen a few times before, similar situations where now that we are back in the markets and holding top-ranked securities according to our universe, we tend to see this catch up fairly quickly. So we'll be interested to see what happens over the next 1 or 2 quarters. And then last but not least, the BMO SIA Focus Canadian Equity Fund. Now this again is a concentrated 15-stock strategy, but focused exclusively in the Canadian market. And this had a really good year, considering that we accumulated a fair bit of cash at the start of the year in January when the Canadian markets rallied, and then a little bit of cash in October, similar to the North American fund. What's interesting about this is it performed similarly to the benchmark, but was exposed to a lot less of the risk. So it was almost a low vol strategy for this year. Of course, this will change, and this was really seen in our active share numbers, which was a high active share, meaning we didn't really follow the traditional components of, say, the TSX composite. Very little energy, zero banks, no metals and mining at this point. So we have been a good position within a diversified Canadian portfolio that takes you a little bit out of the traditional names in Canada, which makes us a fair bit uncorrelated to the overall markets. And this is by holding stuff like Shopify and Constellation Software. The tech industry has been a big benefit almost in all of our portfolios for the year, and we'll see if that continues. So that was a quick update on the 5 funds. You should be seeing some commentary, if you haven't already, come out from BMO on all of these, and encourage you to give me a call, or Ted or Jason, with any questions. With that, I'm just going to pass it back to Ted here.
Great. Thanks, Paul. We get a lot of questions from advisors who use SIA asking how they can fit some of the funds into their portfolios. And 2 of the ones that we're getting a lot of questions on are the Canadian focused fund and the global bond fund. So I'm just going to quickly highlight a couple of points for the Canadian fund. Why should you include it as an allocation in your equity? We are overweight Canada. Everyone knows that. Sometimes it's a great place to be, sometimes it's not necessarily, but what we're looking at is having a fund that at this point in time is really not correlated as closely to the index as most other fund managers in Canada. It's very difficult with the size of the market to get outside of the traditional sectors. Over 2019, we had an average active share value of about 90, and the correlation of the fund with the TSX composite is 0.64. That's actually less correlated than the Canadian TSX composite and the S&P 500, and that's why it presents quite a good opportunity. Like Paul mentioned, we don't have any exposure or very much exposure to the traditional energy, banking, or mining sector, and we do have a lot of exposure to utilities, information technology, and such. So it does fit a very good spot. And the second point is tactical. If you have a client, we get this a lot. A lot of advisors are using some of our funds as a tactical sleeve. If you have a 10% allocation to this fund in a traditional 60-40 client, where that 10% is part of the equity, in our green zone, you say 60-40. However, if we go into our red zone, the fund sells all of their equities and goes to 100% short-term Canadian bonds. So that, in effect, you're going from a 60-40 to a 50-50 without you actually selling any of the funds, because this is happening within the fund. So that's just a very specific part where advisors are starting to incorporate some of these more tactical funds to complement and to prepare for any eventuality that might come. So that's the Canadian focused fund. The next one is the global bond fund. And there's just 3 key points here. We have very high quality bond ETFs. So I think Paul mentioned we are only buying investment grade bond ETFs in this fund. So we have no high yield. We have no bonds that are below investment grade. And that's quite important, because a lot of bond funds, especially global bond funds, cover that entire range, and they have the opportunity to buy high yield. And sometimes it's difficult to figure out exactly how much high yield you have in your portfolio. The other side is, the second point is, it is a global fund, so we do have global yield diversification. For the longest time, we had 75% of the fund was in US bonds, and only recently did we actually switch that. So the fund is actually now 75% Canadian bonds and 25% US corporate bonds as well. And then finally, please ask us any questions. We are doing a lot of work correlating bond funds that advisors have in their business with this to see where the correlation is, because the goal is obviously to get an uncorrelated bond portfolio to manage risk as best as possible. And we're doing a lot of work with advisors on how that looks. So after this, if anyone has any questions on the bond portfolios they hold and they want to see a correlation between this and the BMO one, we're more than happy to have that conversation. Like Paul mentioned, in April, we're hitting our 5-year number on this global bond fund, and so far we're showing a 5-star fund over 3 years. So very compelling reasons to look at something like this, and more than happy to have that conversation. But that's enough of the conversation from Paul and I. I know you guys came here to listen to Jeremy, so we'll pass it over to Jeremy for now.
Hi, everyone, and thanks for taking the time to chat. Thanks, Ted. Thanks, Paul, for your update here. So I'm just going to go through some of the changes that we've seen from the charts from the last time we were updated here in October of 22nd. Sorry, I apologize about that. Just had technical difficulties. The first chart I want to go over is the equity action call. The big change obviously has come November 12th. We moved back to the green zone. So if you think back to what we were talking about on October 22nd, we had moved into the yellow zone, but we were still seeing relatively bullish charts. It was more of a pullback, more of a short-term correction is what we saw. Certainly there was potential for it to get worse, but what we've seen, even from what we saw the previous year, the latter part of 2018 going into 2019, a lot of the bearish sentiment that's been coming out of there just wasn't coming to fruition. The market is continually just shaking off some bad news, is shaking off some geopolitical risk, and has continued to move forward. So November 12th, we moved to the green zone. This is our cue. We want to maximize what our equity exposures are within our portfolios up to their maximum levels when we're in the green zone. We did that in all of our products that we manage at SIA Wealth Management, and we've been rewarded so far from November 12th. So a lot of people are concerned that maybe we are in some overbought conditions, things of that nature, but the green zone, and especially looking at it right now, when we get to the next chart here, if you look at the right-hand side, we're in a situation which hasn't happened for some time where the top three asset classes are all equity. We've got U.S. equity on top, Canadian equity in second place. In third place, we have international equity. The big change that happened from our update on October 22nd was really the move between bonds and international equities. If we look, international equities was firmly placed in the sixth position. It was worrisome at the time, but Canadian equity and U.S. equity were still remaining at the top. That gave us some hope, even being in the yellow zone back a few months ago. But what's changed now is that international equity has moved up to the third position, and we see bonds move down to the fifth. So this is a more traditional appearance of a green zone, a stronger green zone. When we look back historically over where our asset class rankings have been, the only potential negative and we saw Canadian equities drop back one spot, is that commodities lost a spot from fifth to sixth position during this process as we saw international strengthen. So it wasn't so much that commodities had tremendous weakness, it was really just a function of how much strength international equity had and moved up to the third position and pushing bonds down. So risk off, we're seeing the large pools of money, the cash flows have been moving out of short-term, mid-term, and even some of the longer-term fixed income products, and have been re-engaging with risk assets. So those money managers around the world that were looking to take risk off have been putting it back on over the last few months. So that's good to see U.S., CAD, and then international in the top three. So good news for us on the equity side. When we look at this chart, we updated it, and I've highlighted on these charts where we were on October 22nd last year. We've seen a good breakout on our broadest based evaluator. This is our SIA Market Equal Weight Index. So this is taking into account U.S., Canadian, and international equities. So there's an equal weight bias on all these. So we're not preferencing U.S. or any of the international based on their market capitalization. We're doing it on equal weight basis. And we can see that if you look at this chart, you can see that consolidation pattern over to the left back to 2017. We've really been consolidating in broad-based equities in whole for almost 3 years now. So it's been a long time. It's been about 2.5 years where we've been moving sideways, just range bound on a broad basis. We've now broken above. So that's great news for equities. Really shows us that the equity action call was right. The breakout did happen after the EAC turned green. So we're seeing that. We can see that the risk reward now is very good. We have a couple of layers of upside here. So there's strong potential, 15 to 20% to the upside, and that 5, 6, 7% to the downside is in our opinion, good risk reward. Moving to U.S. equity, this is our number one ranked asset class. Very, very similar chart to what we see with the SIA market, with the difference that U.S. equities has not been consolidating for as long. Their consolidation really started and the volatility started in that 2018 period. So But again, very similar to the SI market, it broke out. So we saw the reversal, the green equity action call. The money flows moved out of the safer fixed income and currency space and re-engaged back into equity. So material resistance is there. I've commented on the two previous market reports that this was setting up for an extremely bullish point and figure pattern. That pattern has now been completed. So really happy to see that. Those who might be concerned, just watch for that support level there, that 43,292. It'll be hard to read on the screen, but just the bottom portion of that red. A reversal at here would be a sign of weakness, but overall, this is an extremely bullish pattern and one we're very happy to see in our green equity action call. We still see weakness in drugs, but what's been important is that we've seen the rally back in October. We'd seen the semis were coming back to life, which had hurt us in the previous quarter. Software has now regained that, so the technology side has moved back. Aerospace defense continues to be a significant leader. Leisure, health services, diversified services, all significant leaders here. It's really utilities that has dropped at the top, so more defensive names have now moved down. That's in the yellow zone of our sector report, and software has replaced it. So some certainly very positive and bullish news coming from what we've seen on the U.S. equities. NASDAQ Composite, I wanted to bring this up again just because it was bucking the trend. We had seen the U.S. equities look stronger in the last quarter, but what we've seen lately is that in October, I had reported that the NASDAQ was lagging, for the first time in quite some time. The other benchmarks, it has now regained strength over the S&P, the TSX, the world indices. So again, we're seeing that shouldn't come as a huge surprise with software picking up some steam. We still see weakness in some of those FANG stocks, the Facebook, the Netflix, and the Google. They're either in the yellow zone or the red zone, so that's not necessarily great. Apple remaining in the green, but we've seen other names that have helped out. Tesla's been on a great tear of late. So the chart again here, we can see that the consolidation was again back in 2018 on this one, a little bit more with that volatility we saw at the latter part of 2018, but now a significant breakout. So again, just like the previous two charts, a very, very bullish chart on the NASDAQ index. One of the significant changes that has happened since our update in October is the US dollar. So US dollar was already showing a little bit of weakness back when we were doing the update, but now has broken down. So there is now 1.0. This is not a catastrophic reversal by any stretch on the US dollar, but it has shown its first significant breakdown on the chart since going back to about that June, July of 2017. So just a double bottom breakdown here. This does open the opportunity of testing the 126 level. So anyone who's bullish US dollar may see some short-term weakness in this chart going forward, but primarily where we suspect this weakness is showing in the US dollar is more just people taking their safety money that has been positioned in US treasuries, areas of safety within the US market. It's obviously still the go-to place for people to hide, major players around the world to hide their money if they think equities are producing risk. We feel that that money is now being moved out, back into international, back into US equities, back into Canadian equities. So, but this is one chart to watch going forward for any continued weakness. A follow-up on crude, you can see on the bottom right here, on October 22nd, we were looking at a test of the lows of crude back at that time. Since then, it has rallied. It did test the level I had highlighted, resistance between $63 and $64 back in October. It reached that level and has reversed down. But overall, this chart is getting more bullish. We're still below our trend line, but this is a chart that is positioning itself for a test of that. So this plays into that weaker US dollar that we're seeing on the slide previous to that, and plays into potential bullishness in economic growth around the world. So we want to see, if we're bullish on crude, we want to see that $64 and 49-cent level taken out. That would break the consolidation that's really lasted since the early part of 2019, right up until now, and also break that downtrend line. So that would be pretty bullish. This is a chart that we're going to watch closely going forward. Gold, we've spent a lot of time on this one of late. When we did the update in October, we were looking at or at least recent highs on gold, not all-time highs, but highs that hadn't been seen since 2013. It did have a reversal in the last few months, but has subsequently reversed back up and is potentially breakout. So 1585 is a breakout that we're watching for. We believe that obviously the weaker U.S. dollar from the chart before is helping with gold's price, but obviously some of the turmoil that we've seen of late between the United States and Iran is certainly going to play into that as well, and potentially create some bullishness for crude. So overall, the setup that we've seen, I've talked to a number of clients over the last quarter. There has been some apprehension with what's going on geopolitically. We went through, obviously, an extremely big election in the UK with the Brexit side, the Conservatives coming out ahead and suggesting we're going to see that Brexit happen here in the next little while. Obviously, the Chinese and U.S. tensions over trade, what's happened recently with Iran, the market continues to shrug this off. So a lot of the advisors I've been talking to have been sitting on cash, been sitting on the sidelines, been concerned about valuations, been concerned about potential seasonality coming up. In the near future, we would say these charts all suggest that bullishness is still in the market. The risk rewards that you look at on the major indexes, and if you go down to the sector levels and even to the comparison charts, are suggesting that the risk reward levels appear really good right now. So we've been motivated at SIA Wealth to put more cash back to work and talking to our clients along the same lines. So just in conclusion, I just really want to reiterate some of the products that both Paul and Ted were talking about. Our BMO SIA Focus Canadian Equity Fund. This is a product that many of our clients are not aware of, that we have or have not looked at because they're using the SIA chart service potentially to do their Canadian picks. What's different is our universe is significantly different in this product, how we're doing our rotation in it, and we can see that in our active share and our ability to go with the benchmark and produce something different. So we've had clients and partners with BMO that have commented that this really appears to be a sector rotation. So this is something to look for, and would be complementary to your Canadian portfolio on there as well. The BMO Tactical Global Bond ETF Fund, this is another one, been highly overlooked by our clients, has done tremendously well. We've got 5-star status on this on a 3-year basis and does very, very well. If you look at the performance numbers on it, it's competed and beat many of those bond funds that are out there that are overweight on junk bonds and areas of that. So no junk bonds with this. It does very well, saddled up, and our team is happy to help you to show how this can work in your portfolio with your other bond strategies that you have there. And then finally, the BMO Tactical Global Asset Allocation ETF Fund. This is our top seller. This is a great one-ticket solution. Everything we do at SIA is really baked into this product. This is a place where we do all the management. So it's a good place to park those monies that you need a one-ticket solution or a couple of products within it or a few products within it. And it will complement all the other work that you're doing with our other product lineup and areas that you're doing yourself using the SIA chart service. So with that, I think we're going to jump into questions. We're running, I think, right on schedule. So if I believe Ted or Kyle will take over asking some of the questions out.
Yeah, sounds good. So there was a question, Jeremy, I'll ask this to you. Will oil still be good for Canadian dollars now that the U.S. has such abundant oil supplies?
Yeah, I believe so. Certainly we're playing on a global side, but if you look at the weaker U.S. dollar, that's going to help us out. Where you should see crude go up. I mean, I'm assuming you're making the assumption that you're purchasing crude directly or taking advantage of it. The sector itself has not really picked up in Canada, so that's a bit of a different question. There has been more interest in it as of late, but we still see energy ranked really low in there. So I'm looking at crude really just from a barometer of whether there's a forecast of continued weaker U.S. dollar. It's going to give us some forecasting on some of the turbulence that we're seeing in the Middle East. And obviously, global growth is going to be affected by crude within that. So I wouldn't be afraid of it just because of the U.S. supply side. I think there's other challenges in Canada that are there, and hopefully we'll see some of those things abated over 2020.
Okay. I knew we were going to get something like this. There was a question on any news on the updated website and new tools. We're gonna leave that to SIA Charts to discuss. Yes, we're obviously close to launching that, and there's a lot going on. But we are going to we're not going to put a timeline in for today, which is I hope you understand. And then there's a final question, Jeremy, possibly for you. Any thoughts on an international ETF product or a yield product?
Great questions. Certainly the international product has been on our radar for quite some time. We've been doing a lot of work on that for a number of years and have a strategy pretty much baked in. It really comes down into demand. So if there's enough demand from our clients, it's certainly a conversation. Our partners at BMO have been very good at listening. We just want to present them a business case for it, but the product is already designed and been running behind the scenes and doing very well over that time. A yield product, that's something I've spent a lot more time. Most of you have probably seen I haven't been on the road as much as I normally have been. That's largely my travel time has been curtailed because of R&D for the last 2.5, and now we're moving into our 3rd year. We've been spending more time on that as we build products out and new strategies. The yield product is something that we've been working on and have a product in the lineup. So again, these are demand-based. So if you fire me off an email and let me know of your interest, I can certainly express that on to our partners, and we'll go from there. So we're very open to opening new products. We just want to make sure that there's a business case for it for our partners before we do.
Okay. Paul, I have a question for you. And if you have the answer for this, please let everyone know. Are you expecting the Canadian fund to outperform the North American fund short term? It's a tough question.
That's definitely a tough question, especially if Canadian, like this is the thing, the North American fund looks at stocks on both sides of the border. So if the Canadian stocks are continuing on a currency adjusted basis to outperform the U.S., the North American fund is going to start looking like the Canadian fund. So it's a tough question, but if that was the case, then the North American would have a bit of a lag, but that's definitely not the case so far. The U.S. stocks predominantly on a one-to-one basis have been outperforming.
You know, I get this question a lot, and one of the things that SIA does is over a longer period of time, say that 3 to 5 year, and as is evidenced by some of our funds, is over a longer period of time we end up being 5-star funds over a longer period. Short term is always difficult because is a short term fluctuation an inflection point, or is it just short term noise and you need to stay the course? So we're not trying to focus on the short term. We are trying to focus on the long term, and we do believe that long term, our North American fund will outperform its peers, and the Canadian fund will also outperform its peers, which is a very different return profile. But as Paul mentioned, yeah, short term, if Canadian keeps on having strength, then we will own more Canadian stocks in that. So.
Yeah, I'll jump in with that. There's certainly been it's been a long time since we've seen a significant bear market. So one of the areas that we've had tremendous success in 2000, 2002, and 2008 was making big calls on market corrections. We haven't seen one for a long time. So we do track a lot closer to benchmarks. I mean, some of our subscribers that go back a long time are going, well, we remember when you were obliterating benchmarks. You usually need those events during those bear markets. We'll gain a lot. Coming out of the bear markets, we've done better than our peers traditionally for a few years as we focus on the areas that are seeing that cash flow come into them. I just would caution people about complacency too with the market. I mean, right now we're certainly green light. Equity action call is looking really good. The charts are looking good. The comparison charts are looking good. But you know, being prepared for those downturns, because when they do happen fast, as we all know. So our products really line up well with those, and that's where you get those bumps. To Ted's point, over time, that 3 to 5 year, even in an extended bull market as we've been in, we'll keep pace and do well. But we can really shine during those other markets that traditionally hurt other asset managers.
Okay. Okay. If there's no other questions, I don't think there are. We will. We're going to send out a replay of this, and obviously a lot of people were asking for the PowerPoint presentation, so we'll make sure we send it to the people that that logged in. Thank you very much, everyone, for your time, and look forward to a fantastic 2020.
Perfect. Thanks, everyone. And if you do have questions that are more personal, I see a couple that are. We'll address those one-on-one with you after this call. Thanks so much.
Great.